again after a long break of around 2 years, I suppose. And today, our keynote speakers are going to discuss a few matters regarding IFRS 9. IFRS 9 is not something which is recently or something new. It's been adopted a couple of years back, but there are practical issues in this implementation. And obviously for the banks, it's going to be implemented for the first time this year, I suppose. So Rehan and Arslan are going to talk about certain practical implications and the areas which are important for all of us. The session will be followed by a Q&A session. And in that session, you can ask your relevant questions with the keynote speakers. And with this, I would like to request Mr. Arslan Khalid to be here with us and start the session. Thank you very much.
Bismillah ar-Rahman ar-Rahim. Thank you, all of you from SRC and Farrukh and all friends who are here. IFRS 9 is a topic that I think we have been discussing. We had many seminars starting from maybe 2010 when I think we had a first seminar on IFRS 9 at that time. IFRS 9 was an exposure draft stage. The standard was finally issued in 2014. And so we had lots of discussion in ICAP at different forums on IFRS 9, and particularly with focus on the banks and financial institutions, how they are going to cope up with the challenge of IFRS 9. In this session today, we will have a lot of re-emphasis on the IFRS 9 key areas, but I think the special focus and attention would be the practical issues that are emerging as we are coming closer to the IFRS 9 implementation, particularly for banks, because for non-banks, I think we've already had a round of IFRS 9 financial statements. I think 2 years have gone by, but with certain limitations because of the government sector receivables, which remain, subject to exemptions on IFRS 9 applicability. So the focus of our session today is going to provide you some overview of IFRS 9, and also then we will have a deep dive session on the expected credit loss model, which is the heart of the standard, and which is the area which is going to affect the way the provisioning and loan loss and credit loss provisioning is looked at by the banks. So just to give you to start with some background, I think as you all know, I think IFRS 9 concept is basically goes back to 2008 financial crisis, and 2008 financial crisis basically exposed a lot of weaknesses in the accounting standards at that time, primarily IAS 39. The standard was highly criticized at that time by the stakeholders because on the premise that the credit loss model under IAS 39 is based on incurred loss model, that you do not recognize credit losses till the time the credit loss is on the surface, the default has occurred, which is kind of a very delayed approach to recognize the credit loss, because in case of banks and financial institutions, it is inherent in the nature of the business that since they are writing or underwriting so much of the credit exposure, there is going to be a credit loss, and the expectation of credit loss is not built in the accounting of the credit loss. So the accounting at that time under IAS 39 was based on the incurred concept that until and unless the loss is crystallized, then you start thinking about how much of the loss needs to be provisioned against, and the objective evidence of impairment was the triggering point before you start making a provision, which is not in line with the inherent business model and the character of the business, that the expectation of credit loss has to be built in the loan loss provisioning. Because if you look at the price of the loan, the interest rate also contains two broad elements. One is the time value of money, and also the credit risk premium. That credit risk premium is the price that a bank charges for the credit risk that they undertake from the day one. So when you book a loan, you also book a price, or you also charge a price to the customer for the credit risk that you undertake on a loan. That income continues to be accounted for from day one. The risk or the loan loss may occur, say, after 3 years or 4 years down the line. And at that time, if you book a credit loss, so there's a mismatch between the income recognition and also the credit loss booking, which actually needs to be bridged in through an expected credit loss model as a theme of IFRS 9. So what happened was that, Financial Stability Board and Financial Crisis Group recommended to ISB and other stakeholders that the existing accounting standard, which is IS 39, needs to be revamped, and a new accounting standard has to be built up based on the issues and weaknesses that were considered at that time. 5 years is a time period which ISB took to prepare this standard from 2009 to 2014, and the final version of the standard was released in 2014 with the implementation date of 1st of January 2018. So the world adopted the standard IFRS 9 from 1st January 2018, which means 18, 19, 20, 21. Globally, 4 years have passed by with the implementation of IFRS 9. Now, the situation in Pakistan, obviously, the State Bank never adopted IS 39, because in 2000, IS 39 was issued, and at that time, the State Bank and the banking sector thought that because IS 39 brings much subjectivity to the loan loss provision, because it requires an evaluation of the future cash flows to determine the impairment loss, etc. So it's not feasible to apply the standard on the Pakistani banking sectors, and they decided to continue with the regulatory regime driven by the State Bank for not only for loan loss provision, but the entire accounting of financial instruments. So historically, the banks are in 2000, when the IS 39 came, I think that was not adopted, and the banks actually adopted a regime which was regulated by the State Bank through its various circulars and prudential regulations. So the regime of accounting, as is also prevalent today, is not driven by any accounting standard, but by the prudential regulations and also various accounting circulars which are issued by the State Bank from time to time. And the shape of accounting given by those circulars has certainly inspirations from IS 39 principles. If you look at the investment accounting, the classification, also there are certain areas of provisioning which are covered through the prudential regulations in terms of time-based bucketing and subjective evaluation, so on and so forth. But you can recognize the problem when you do not adopt a full standard, whether it's IS 39 or IFRS 9 or any other accounting standard, and you adopt a regime which is covered through circulars and regulations, you do not address the full issue comprehensively. So you do not actually cover all areas of the accounting of the financial instruments. You might be dealing with certain areas, like key areas, like value, how the investments would be valued, how they would be classified, how they would be measured, how the loan loss would be determined, etc., and etc. But you're not comprehensively providing an accounting standard, even local accounting standard, to deal with the financial instruments accounting. So what happened is, because we never adopted IS 39, we still are evaluating IFRS 9 with an adoption date of the current year, and we'll come to that. So transition in Pakistan is not going to be from IS 39 to IFRS 9. It is going to be pre-IAS 39 phase, which is state bank accounting regime to IFRS 9. So while the world is moving from IAS 39 to IFRS 9, we are moving from the state bank accounting regime to IFRS 9, and that has its own peculiarities and issues, because certain issues which are already settled in IAS 39 will now emerge when you apply IFRS 9, because it's the first time the banking sector will be applying an international standard, a comprehensive international standard on financial instruments. So a lot of legacy accounting that was accepted on the basis of state bank principles or because of the absence of any guidance. Because the state bank, for example, directives are not talking about amortized cost concept. They are not talking about effective interest rate concepts. So where there's a vacuum, the banks continued with the existing practices and which are inherited from decades. So keep in mind that we are transitioning from not IAS 39, we are transitioning from state bank regime to IFRS 9. So when you keep that in mind, the areas of accounting which will get impacted will be A, investment accounting and valuations, because we have a state bank circular-driven classification and impairment requirements, and we are going to adopt a business model and a principle-based approach under IFRS 9 for classification and measurement of the investments. That may not be a bigger challenge, because I think IAS 39 principles to a larger extent were incorporated in the state bank circular, but we'll see that how the conceptual basis has changed even from IAS 39. The second impact area certainly is going to be the expected credit loss model. The state bank regime covers the age-based provisioning, which is past due status by 90 days, 180 days, 360 days, and you have a specified percentages that are to be applied on the respective time bucket to determine the provision. That's a very mechanical way to determine a provision. Now that mechanical approach is going to be replaced with an IFRS 9 highly sophisticated, futuristic expected loss model, where you even not will consider only impaired exposures, but you're going to predict that how much of the exposures will go into default in terms of their probability to go into default, and then you have to estimate that how much is going to be the amount of loss which will translate in the future as a credit loss, and the present value of their credit loss has to be booked now. So we are moving from a very mechanical approach to a very judgmental approach, and that is why a very robust accounting model is needed to deal with the situation. And the State Bank also have provided certain guidelines how the expected credit loss model is going to be implemented, what approaches and methodologies. We'll also look into that as well. The third area, which I think people are not giving much attention, is the effective interest rate method approach. Because, as I said, IAS 39 was not applied. So many of the banks have certain streams of income which continue to be accounted for based on the underlying contracts. Like, for example, in the corporate finance income, syndication fees or initial fee is charged on the basis of an arrangement where a participating bank wants to charge certain upfront fee. Under IFRS 9, all kinds of fees and incomes which are closely related to the origination of a loan have to be amortized as part of the interest income under the effective interest rate method. So many of the income or initial fees under particularly the corporate finance arrangement have to be evaluated whether or not those fees actually have to be recognized as part of an effective interest rate method over the time of the loan rather than upfront. That is a practice internationally, and I think in most cases the banks in their internal evaluation consider those fees as part of their IRR on the loan. in accounting terms, this is not translated, and the income is recognized on upfront. Amortized cost concept is also not, as I said, is not discussed in the State Bank standard. So you see the loans appearing on the balance sheet at their original disbursed value. So they are not, we are amortizing on government securities where premium discounts or over the period of time, but that's only where amortized cost concept is applied. Effective interest rate method will also affect certain other income stream, for example, your LC commissions or your areas of trade commissions, or if certain banks are recognizing those income upfront on receipt basis, I think those have to also be amortized over the term of the loans. Certain credit card incomes or transactional income or that have to be recognized as part of the effective interest rate method. So those income streams have to be closely looked at, because the bank's income streams can be divided into two broad categories. One which are covered by IFRS 15 as service-based income, and the other which is not covered by IFRS 15 and they are covered under IFRS 9. And then you have to decide, in most of the cases, if they are part of the origination of the loan, such as loan processing fee and all other examples that I've just explained, they have to be amortized rather than recognized upfront. The third is also the initial recognition of certain financial instruments. Like banks also have below market like credit lines, like from the State Bank you have export refinance, your other schemes which are, after COVID, many of the schemes have been launched, which are concessional loans to the banks. Banks also are then required to pass through those concessional loan to the customer. So you have on one hand on the balance sheet liabilities which are below market, and on the other hand assets which are below market. Under IFRS 9, if you have a below market financial instrument, that it has to be then fair valued on initial recognition. So the loans have to be fair valued on initial recognition, that you're borrowing, and also the asset that you create also have to be recognized at fair value initially. So those accounting areas are not touched because we are not into the IS 39 scheme. But when you come into the IFRS 9 regime, those problems also have to be accounted for. There are restructurings. Now, when you have entered into a restructuring arrangement, you may provide certain concessions in terms of freezing of markup, or for certain period concessional markup. Under IS 39 and also under IFRS 9, if there is a substantial modification in the terms of a loan, then you have to de-recognize the loan and original loan and recognize the new loan at fair value, and the difference goes to the P&L. But that concept is also not applied currently because we are not under IS 39. So when you actually will move to IFRS 9, you have to evaluate all kinds of restructurings, whether or not there is a substantial modification, and the test for substantial modification is that you compute the present value of cash flows under the original terms and the present value of cash flows under the revised terms, and the difference is more than 10% in the present value. It is normally considered as a substantial modification in the terms. In that case, de-recognition of the original loan will trigger, and the new loan under the revised term needs to be recognized. So I just wanted to highlight that there are bits and pieces of the financial instruments accounting which are, this puzzle is not complete unless we recognize and we adopt the standard comprehensively and fully. So while the focus is more on the expected credit loss and investment accounting and the transition from the current regime to the IFRS 9 regime, we should also not lose sight of the fact that the other areas which were not touched because of the State Bank instructions regime will also come to in focus and will also have to be transitioned under IFRS 9, and that could result in material impacts on the financial statements of banks. So now I think let's start looking at areas one by one. I will try to cover the the investment part and also some of the high-level expected credit loss. But I think then we have a deep dive session by Rehan on the modeling on expected credit loss. I think that will be more focused on practical angles on how the ECL approaches are applied in banks. So to give you a broader view on the investment accounting, under IFRS 9, the first step is to, before you apply investment accounting, is to distinguish between whether you are dealing with equity or you're dealing with a debt instrument. And the definition of what is equity and debt is discussed under IS 32. It's just not a legal form, it's also the substance. That equity is a residual interest in an entity and debt is a financial obligation of one party. But at the end of the day, there is a definition of what is a debt instrument under IS 32 also, and there is a criteria under IFRS 9 which needs to be applied before you conclude that this is a basic lending arrangement or a debt instrument. So first look at an equity instrument, because equity instruments, the accounting is not much changing. You have to classify your portfolio into two categories, held for trading and non-trading. So anything which is held for frequent trading in terms of the business model of a bank, and I think all banks have this process and differentiation that what part of their portfolio is held for trading, because the trader is then have delegated powers and certain targets, etc. And there is a monitoring mechanism with limits, etc. on how the held for trading portfolio will be dealt with. So the held for trading portfolio is easily identifiable in a bank situation. And the held for trading portfolio have to be carried at fair value through P&L. So the accounting is not changing, which is straightforward. For non-trading investment, I think the accounting under IFRS 9 gives a choice. And this is a one-time choice at the time of adoption of the standard, that you either choose for fair value through P&L accounting or fair value through OCI. In the event you choose fair value through OCI approach, then it is a permanent choice that you are not going to reclassify investments out once categorized at fair value through OCI. And the other important aspect is that the gain and losses that go to OCI will remain permanently in OCI even when the investment is sold or derecognized. So the old concept that when you realize an investment, the capital gain is also recognized and is transferred from OCI to the P&L is gone. And the gain or losses, whether you dispose of the investment or you continue with the investment, that will remain permanently parked under the OCI statement. The only difference will be when you sell the investment, the gain loss will be transferred from OCI reserve to your normal retained earning reserve. But it will not move to the P&L. That is a big change, because if you look at the financials of many of the banks, capital gain is a substantial part of their income. So the P&L of many of the banks have a very material item, capital gains, which are realized from the surplus to income on disposal of investments. And this is pretty much in control of the banks, that there is a surplus on certain portion of the portfolio, and if you want to realize that gain and boost up your P&L, that can be done very easily close to the year end, and that gives a capital gain on the P&L to reflect on your performance. So if you choose portfolio to be classified as OCI, that leverage or flexibility will no longer be available, because the gain will remain in OCI, will not be transferred to the P&L account. So that's, from a business point of view, is going to be an impact for banks, that they have to be careful in selecting what they classify at fair value through P&L and what they classify at fair value through OCI. In the event they want the gains to be reflected in P&L, then they also have to take exposure of the loss, that in case of volatility, that P&L will be affected through that volatility. Like, we are currently in a loss scenario, so the banks will, in case are at fair value through P&L, then obviously this year will show a loss on the P&L. And if the next year things change, certainly they will have a benefit. So that's volatility is the angle which most of the banks would have to consider, and that's the reason you will see that the approach likely is going to be to keep most of the portfolio in the OCI rather than at fair value through P&L, because the entities normally are risk averse and they want to keep their P&L away from the volatility. So as a result, I think the likelihood is that we will find bulk of the portfolio classified at OCI. Sorry. For unquoted equity investment for years, I think we have been following this policy that lower of cost and breakup value. And this is coming from the prudential regulation. If you have an unquoted equity investment, you are allowed to keep it at lower of cost and breakup value. Certainly breakup value is a very obsolete concept. It has no linkage with the fair value of a company, especially an unquoted company. Imagine you're talking about a tech company or a startup, and you're looking at the breakup value of that company as a proxy to the fair value. I think that is there is no linkage, there is no rationale to look at that way. So anyways, I think that rule of breakup value and cost is quite obsolete. And the new requirement in IFRS 9 is that for banks especially and financial institutions, it is a mandatory requirement to fair value all their unquoted securities and equity investments. Obviously, banks do not have a larger portfolio of unquoted equity security, but they do have investments, maybe for strategic reasons or for other reasons. But there is a portfolio of unquoted securities and unquoted equities that have to be fair valued. And to that extent, you will have to face the volatility in the P&L account. On the initial adoption, all the impacts will go to the equity, but as you go year by year, and there's a change in the fair value of those securities, certainly the impact will come directly into the P&L. So this is also a major change, and also some cost associated with it, because obviously there is a hassle to apply valuation techniques on unquoted securities. You have to engage experts, etc. Now come to the debt side. I think the basic starting point is, first you have to look at the character of the debt security, whether it is a basic lending arrangement or it's something else. What is a basic lending arrangement? That which only provides you either principal in return or interest. So anything which provides return in the shape of either your return of your principal or interest is a lending arrangement. If it's providing you anything else, it's not a lending arrangement. Now what is interest is also of interest, because you have to look at interest. What is interest? Interest is, again, can be broken down into two components. One is the time value of money, and other is the credit risk that you, credit risk premium that you charge for the credit risk that you undertake for that debt instrument, plus some administrative cost element also. So if an instrument is providing anything else other than the credit risk premium and time value of money, like most of the credit instruments are CIBOR plus 2% or CIBOR plus 3%. CIBOR is proxy for the time value of money, and 2% or 3% or 1% is really the credit risk premium that the banks are charging. So, but if an instrument is, for example, the return is linked to commodity prices, or the return is linked to gold prices, or the instrument is convertible into, it is an equity conversion feature, which means the return has also elements other than the time value of money and the credit risk. In that case, that instrument will not meet the test of basic lending arrangement. And in that case, it has to be fair valued. So the first step is you have to distinguish between a basic debt instrument, plain vanilla debt instrument, and a debt instrument which has other factors built into the return. So for example, the tier 1 instruments issued by various banks. So term finance or bonds and which are tier 1 instruments under the state bank guidelines. Now they are convertible into equity in certain situations. So the price that the lender is charging is not only because of the credit risk, but also of the risk of conversion. And that's the reason why it may not meet the character or classification of a basic lending arrangement. Certain preference shares are convertible into equities. Certain instruments, mutual fund units are not basic lending instruments because their fair value is based on the net asset value. They do not provide just the return in the shape of interest or the principal return, but their value changes because of the net asset value. And also the fact that under IS 32, they are open-end mutual funds are putable instruments, and putable instruments by definition meet the definition of a financial liability. So the counterparty, the mutual fund, has a contractual obligation to pay you redemption value on demand, and that's the reason it meets the character of a financial obligation. So technically, it is also not a basic lending arrangement. So those instruments will go into a fair value through P&L category rather than be a debt instrument to be accounted for under IFRS 9. Once you are out of those special kind of debt instrument with factors other than interest, then you have to apply a business model test, that the purpose for which you are holding those instruments. So the business model could either be trading purposes, you are holding debt instrument for trading purposes, frequent buy or sell, or it can be to collect its contractual cash flows. So you are holding a bond or PIB or T-bill because you want to, this is your business model, that to only invest in long-term bonds for the purpose of collecting all the contractual cash flows. And that business model will determine that it's a hold to collect model, and hence a different accounting. And the third model could be you have a dual model. You actually have those instruments. You want to collect contractual cash flows, but in the meantime, if for liquidity reasons you need cash, you will sell them. Or if your target return or anticipated return is not materialized, then you might change the portfolio. You sell one instrument, buy another, so far as your target yield is met. So there could be an infrequent selling out of that portfolio. In that case also, it's a dual business model. So you can have three kinds of business model: held for trading model, hold to collect model, or dual model, where the portfolio is held, but it also can be sold in times of liquidity need or to meet certain target returns, etc. For the first category of business model, you actually have to apply a fair value through P&L approach. For the second category, which is hold to collect, amortized cost accounting is allowed, because the purpose is to hold a security till to realize full contractual cash flows. So you are not interested in the market fluctuations, but you want to hold that till end. And the third is the dual business model, that because many of the banks, and there is a certain portion of portfolio which is held for liquidity need purposes to meet SLR requirements and other requirements, that they might sell out of that portfolio when there is a liquidity need, and also when there is a requirement to meet the target return. Because when you invest in any portfolio, at that time you also decide that how much of the return you are expecting from that portfolio. So that is part of the business strategy and investment decision, and that will also drive in the determination that what is your business model for that portfolio of investment. So the ELCO decisions and how they are taken will become very important in determining that what is the business model behind a portfolio. This is not an instrument by instrument classification. It's a portfolio level business model. So a bank can have different business models in terms of different portfolios. So one of the portfolio is managed separately, which is trading. A trader is day in, day out trading at that portfolio to gain short-term margins out of the fluctuations in the interest rates. There is a separate portfolio which is managed differently in terms of hold to collect model. And there could be a separate portfolio where the purpose is to hold it for a target return and only change the portfolio components when the target returns are not met or when there is a liquidity need. Otherwise, you are not normally touching that portfolio. So there are well-documented policies in a bank which will help you determine that what is a business model associated with a different level of portfolio, and hence that business model will determine the accounting. So there is a match of business reality with the accounting reflection. So why you have invested in something, what is your plan of making money out of that investment is going to determine how you are going to reflect the accounting of that portfolio. So the idea is to bridge the gap, and that the accounting is in isolation, for example, working on intent basis, that somebody deciding that it's a held to maturity, held for trading. This is just intent on instrument by instrument, no relevance with the business model. And therefore, it has a larger exposure to manipulation, because when you basically determine the accounting on the basis of intents rather than factual realities, then obviously you can change those intentions depending on how the market is moving, how the circumstances are whether those circumstances are suiting you or not. So the idea of IFRS 9 is to link the business realities with the classification and measurement of financial instruments and investment portfolios. So in any of the banks, the investment strategy clearly spells out the purpose of holding certain portfolios, and those purposes will have to be taken into account when determining the classification. You can see that the IFRS 9 is requiring more and more fair value. There's only one situation in which investments are allowed to be held at amortized cost. And what is this situation? A, it has to be a basic lending arrangement, and B, your business model should be to hold those instruments to collect contractual cash flows. Unless you are in that situation, all the financial instruments are carried at fair value. So the more fair value which is coming into play. Because when IFRS 9 was in making, I think there was also a debate that, whether we should remove this inconsistency that certain financial instruments are carried at fair value and certain are at cost, which is called a mixed model, or we require all instruments to be carried at fair value, so it's an internally consistent approach. But ultimately, I think ISB felt that there is a merit in keeping certain instruments at cost, because the business model and the business reality is that the purpose of that investment only is to determine, is to realize the cash flows and interest income which is built into that contract, rather than through a market movement. So maybe a bank has built up a portfolio of PIB which they have bought at higher rates when the interest rate was 12% or 13%, and they want to keep those PIBs for stable profits over the 10-year period, which means their business model is not to do anything with that instrument other than to realize the interest income. So that strategy has to be reflected in the accounting. I think this is something we just been through. So on the ground, if you look at the bank's classification in terms of their portfolio, you will find 80–90% of the portfolios are classified under AFS category of banks. Very tiny portion is in held to trading, and very small portion is in held to maturity category. I think 80–90%, if I remember correctly, across the banking sector in the AFS portfolio. So, and I think on IFRS 9 implementation, bulk of that portfolio, which is normally government securities, I think will be classified under the dual model that they want to keep that security both for selling purposes if the need arises and also for collecting contractual cash flows till the time there is no liquidity need and till the time the return is according to the expectation. So I don't see a much change in the investment accounting area on adoption of IFRS 9, but the only change is going to be on an equity area where you will not have an opportunity to transfer gains to the P&L on disposal of investments, which is going to change the P&L complexion in many cases. And I think we have to break. So I think from here, what is incurred loss model for what is expected loss model? I think Rehan will carry over, and I think we'll take you through the whole approach to the ECL modeling. Maybe we have to break for the namaz, and then I think we will. Okay, thank you. Thank you so much.
Welcome back, everyone. First of all, thank you, Arslan, for a very useful and informative session. We'll continue with the discussion on IFRS 9, and Mohammad Rehan, who is the director in EY Ford Roads, he will be continuing with this presentation on the remaining part. Thank you very much.
Okay, can you hear me? Yeah? Now you can hear me? Yeah, okay. So, Assalamu alaikum and good evening. So, Arslan has covered the overview of IFRS 9 and classification and measurement requirement of IFRS 9 in the first session. And that was one of the areas of IFRS 9. So, other areas include hedge accounting and impairment of financial assets. So we are not covering hedge accounting today because hedge accounting is not quite common in Pakistan. Still, if you have any specific case, you can always, consult with us or with your accounting advisor. But I'm going to cover impairment of financial asset, which is the most interesting and complex area of IFRS 9. So let's start with that. And I believe that most of you have already gained experience of implementing IFRS 9. But those of you who have not been through the implementation of IFRS 9, you do not have to worry. So I'll try to, maintain a balance between the theoretical aspects of IFRS 9 and the practical aspects of its implementation. IFRS 9 actually prescribes expected credit loss model. Currently, we are using incurred loss model. So under incurred loss model, you are required to make a provision when there is a objective evidence of impairment. So default has already happened. For example, the loan has passed due by say 90 days, or you have classified that loan based on subjective criteria. Yeah? But under the expected credit loss model, you will have to book a provision even if there is no objective evidence of impairment. So it's a futuristic loss estimation. IFRS 9 actually does not prescribe any methodology for computation of expected credit loss. But it sets out certain principles within which you can adopt any methodology of your choice. So any methodology, any recognized methodology, I would say, that takes into account the historical information and that can compute the few forward-looking loss rates is acceptable under IFRS 9. Generally, the methodologies for computing ECL actually come from the computation of capital charge under Basel framework under the advanced approach. So these were there previously. Before implementation of IFRS 9, these were there. But you can now use those methodologies for IFRS 9 by making certain adjustment to those methodologies. So I'll explain to that what is expected credit loss. So what I have done is I have actually divided the approach of computing ECL into different steps, into different stages. So stage one is portfolio segmentation and staging. So portfolio segmentation means you cannot, compute expected credit loss on entire portfolio. So you need to narrow it down to a level that best represents its risk characteristics. So this is the first requirement. We'll talk about that. Standard also talk about segmentation as well. Then you have staging. So standard requires you to divide your portfolio into different stages. So we'll talk about staging as well. Then step 2 and step 3 are loss rates. So it's estimation of probability of default, like what are the chances that loan will go into default. Then you have loss given default. Said if a loan goes into default, what you're going to lose on that loan. So you will not lose the entire amount of the loan. You will recover something out of it. But that amount that you will lose is your loss given default. So we'll talk about the probability of default and loss given default estimation approaches. Then you have exposure at default. So exposure at default is a kind of outstanding principal on your balance sheet, outstanding principal of your financial asset, or outstanding markup on that financial asset. But it is not restricted to outstanding amount, because in banks you allow limits to your borrowers. So borrower can use that limit, and when he asks for that limit, you will have to accommodate that borrower. So we'll talk about that. What is exposure at default? How it is computed? Then the last step is the computation of expected credit loss in various scenarios. So IFRS 9 actually says that it has to be in probability weighted scenarios. So you cannot use one scenario. So one scenario would not suffice the requirement of IFRS 9. You need to build more than one scenario. So it could be 2, it could be 3, depending on your methodology. So let's start to discuss this one by one. Sorry. So let's start with the segmentation. So if you look at the balance sheet of a bank, you will find these assets: funded loan book, you will have financial commitments, the limits that you have granted to your borrowers. Then you have unfunded financing facilities like letter of guarantee, letter of credit. Then you have investments in debt securities. Investment in equity securities are exempt from ECL requirements. Arsan has already talked about that. Then you have lending to financial institutions and balances with banks. These are also exposed to credit risk. So you need to actually estimate ECL for those as well. Then there are other assets. Generally in other assets, you park markup receivable, and there may be any other asset where you have contractual right to receive cash. So that are also subject to ECL requirements of IFRS 9. IFRS 9 actually allows you to compute ECL on individual asset level. So for example, you have an XY and company as a borrower, so you can compute expected credit loss for that borrower as well. But the difficulty here is that the probability of default and loss given default for that borrower is not available in our company. PDs are not published here. So you cannot identify the loss rate for a particular borrower. So IFRS 9 allows you to actually combine those borrowers with similar risk characteristics and compute the PD and LGD for that group of borrowers. So this is allowed under IFRS 9. So how we can do the segmentation in case of bank? So bank have internal mechanism, to rate its customers, like obligor risk rating. So you can do segmentation based on that. First, you will do broad segmentation like corporate portfolio, commercial portfolio, consumer portfolio. But again, loss rate cannot be applied to these portfolio at that broad level. You need to narrow it down to obligor risk rating level. So obligor risk rating 1 will include certain borrowers with similar risk characteristics. Similarly, obligor risk rating 2 will contain certain borrowers with similar characteristics. So and so forth. So you will, in this way, you will segmentize your portfolio. You can also do further segmentation, but it depends on whether the data for loss rate is available at that level or not. So for example, you can do within obligor risk rating 1, you can do, say, industry-wide, textile, cement, or any other industry. But the problem is that you cannot, gather sufficient default points at that level. So I think if the bank use that obligor risk rating model for internal risk assessment, evaluation, or monitoring, so in that case, that would be more appropriate segmentation for that loan. So this is for rated portfolio. For non-rated portfolios like consumer portfolios, where you do rating at the time of origination of the loan, but not subsequently. So in that case, you cannot segmentize those loans according to their scorecard or according to their obligor risk rating. So in that case, what you can do is you can do segmentation on product basis. Like credit card is one segment, yeah. So you can also divide that into further segment, like geographical basis, southern region, northern region, and similarly you can divide them according to type of underlying borrowers, low income borrowers, medium income borrowers, or high income borrowers. That can be done. So this is how segmentation is done under IFRS 9. So the emphasis is that you should use those segmentation that your company is internally using. Otherwise, it would be very difficult to gather the data for that. So it will become impracticable to compute expected credit loss. Sorry, excuse me. Yeah. Okay, once you have done the segmentation, the next stage is to divide your portfolio of that segment into 3 stages. This is the requirement of IFRS 9. Stage 3 is very, very easy. Stage 3 is your NPLs. So anything that is in default, according to your default definition, would go to stage 3. Now, stage 1 and stage 2 are for performing portfolio. So why stage 1 and stage 2 in performing portfolio? Because in stage 1, you are required to compute expected credit loss on 12-month basis. So it will attract 12-month expected credit loss. But if the loan is in stage 2, it will attract lifetime expected credit loss. Yeah, so the level of provision will be different in stage 1 as compared to stage 2. Now the next question arises, how the loan will move actually amongst these rating, these buckets. So here the standard introduces the concept of significant increase in credit risk. So it's a measurement of credit risk from origination of the loan till the reporting date. So standard says that if that credit risk has increased significantly at the reporting date as compared to its origination date, then loan will go to stage 2. So whenever you write a loan, it will go into stage 1. If the credit risk has increased significantly on that loan, it will go to stage 2. So that is how the loan will move amongst these stages. So next question arises that how to measure that significant increase in credit risk. So let's talk about that. Standard says that if a loan has become more than 30 days past due, then it is presumed that the credit risk has increased significantly over that loan. It's a rebuttable presumption. You can rebut that. It's not fixed, it's not mandatory. You can rebut that presumption based on your historical data. If you can demonstrate that the delay in the payment is due to, admin reason, not for credit deterioration reason. So in that case, you can rebut that 30 days presumption. So normally in Pakistan, you will get the payment, say, in 50 days, 60 days. So if you can demonstrate that the loan will revert back to regular after going into 50 days or 60 days, so in that case, you can rebut that presumption. Secondly, standard says that there are certain criteria given in the standard that you can monitor these, and based on that, you can judge whether the credit risk has increased significantly on a particular loan or portfolio of loan. So these are, if you can see on the screen, changes in the external market indicators, changes in the internal price indicators, adverse changes in the business, changes in the financial performance and financial condition of the borrower. So generally in banks, all of these criteria are included in the obligor risk rating. So you do not need to separately monitor these things. These are part of your obligor risk rating. So you can use obligor risk rating to measure credit risk. And there is another concept of low credit risk expedient. Now what this expedient is actually. So IFRS says that in some situation you do not need to actually measure credit risk from origination to reporting date. What you can do is just assess whether your financial asset is in investment grade or not investment grade. Investment grade is your BBB minus. So if it is in investment grade, it means that it should be parked in stage 1. But if it is in stage 2, if it is not investment grade, it will be parked in stage 2. So this is the low credit expedient available for those investments which you have not originated yourself. So this will not be applied to loans and advances. For investments or bank balances, for lending to financial institutions, these kind of assets you can apply low credit expedient, but for loans you cannot apply low credit expedient. Because you have originated the loan, you know what was the rating at the time of origination, what is the rating at the time of reporting. So you need to take those ratings into account while measuring this credit risk. So summarizing all of this, you can develop this sort of criteria for staging of your financial assets. So delinquency we have already discussed, 30 days past due, the loan should move to stage 2. So by the way, first you need to decide the stage 3. Stage 3 is easy. Anything that is NPL defaulted, it would go to stage 3. Then you need to decide the stage 2. Stage 2 delinquency criteria, first criteria, then obligor risk rating criteria. You can, judge the credit risk based on different scales in the obligor risk rating system. For example, if the loan was originated in obligor risk rating 1 category, and at the reporting date, its category is say 4. So it has been downgraded by 3 notches. So it represents a significant increase in credit risk, then loan will go to stage 2. So that is how other, obligor risk rating works. Then you can add other criteria as well. You can add watch list if not already part of the obligor risk rating system. I think watch list is already part of the obligor risk rating system. So rating 9 and rating 8 is your watch list. If not included, you can always add that over and above these obligor risk rating criteria. Then you have restructured facilities. If a loan has been restructured in the past 1 year, so it cannot be a high quality loan. It should not be in stage 1. So in that case, you need to transfer that loan in stage 2. So this is broadly the criteria for staging of the portfolio. So by now, what we have done is we have segmentized our portfolio, and within the segment, we have created the stages of the portfolio. Now, next step is to estimate the ECL, how to actually compute ECL. You have divided the portfolio into stages. You have divided the portfolio into segments. Now, how to estimate ECL? The standard says that because it does not give you any prescribed methodology, it says that you should use information that is historical. You cannot ignore the historical default rate, historical experience of that particular portfolio of loans. And you will also have to incorporate the forward-looking scenario into that. Yeah, so forward-looking means macroeconomic factors you need to consider into that. So this is the first requirement of the standard for ECL computation. Then it has to be probability-weighted, scenario-based. As I said earlier that it cannot be in one scenario, it has to be more than one scenario. That will be probability-weighted. Thirdly, time value of money need to be taken into account. You cannot ignore time value. So this is the basic principle of IFRS 9 under which you need to compute expected credit loss. So now let's see how we can estimate different parameters that will be used for estimating the expected credit loss. So you can see the equation. The equation is not different from calculation of provision under current regime. So if you consider this PD and LGD as a loss rate, and that is applied to your outstanding principal. So that is how we compute, provisions under the current regime, yeah. But the difference is that because it's a forward-looking provision, this loss rate has to be forward-looking. It should be based on probability of default. What are the chances that loan will go into default? And then if the loan goes into default, what you're going to lose on that? So that is how you compute your loss rate. But this equation is not as simple as it looks. The difficult one is at the bottom of the screen. So this computation is actually, done by the calculator. You cannot do that on Excel file. This is done by a systematic calculator. Because the calculator actually plots all the cash flows of the loan according to its contractual terms, apply the probability of default, loss given default at each repayment date, and then discount it back to the reporting date. So this cannot be done manually, especially in case of banks, this cannot be done manually. Other companies you can do on Excel as well. Okay, so now let's discuss how we can determine PDs, LGDs, and exposure at default. So let's have a discussion on approaches for computing those. So as I said that for rated portfolios, you have obligor risk rating in place. So in that case, you can use that obligor risk rating to compute PDs. So what you can do is, you can observe the transition of those ratings over the year and come up with a default rate. So I'll give you an illustration for that. So this is the migration matrix. So here on the vertical axis, you have old ratings, like rating for say, my observation period is 6 years or 7 years. So I'm starting from 2013, and I'm looking the migration of 2013 rating to 2014 rating. So this is 2013 old ratings. On horizontal axis, you have new ratings, ratings of 2014. So in 2013, there were 127 borrowers that were rated 1. If I look those borrowers in new year 2014, one of 101 stayed in rating 1, 14 moved to rating 2, similarly 1 moved to rating 6. So I observed the transition of the ratings through this migration matrix. Yeah. Similarly, if you see the 9 rating, so 9 rated customers moved to, one customer out of those moved to rating 6. So that is how I compute default rate on my historical portfolio. So this will give you a default rate, historical default rate. Now this default rate will need to be statistically calibrated. So statistical modeling will be used to calibrate that default rate. Because sometimes what happens is that in rating 4 you will find more default, but in rating 8 you will find less defaults. This cannot happen. You know, a default should go from lower rating scale. Yeah. So in order to remove that anomaly, because you will find the curve like very haphazard curve like this. So that curve need to be calibrated, and calibration can be done by any statistical regression. So generally we use logistic transformation method to actually calibrate these default rates. So it will give you a best fit curve according to your portfolio. So that is how actually we compute probability of default on rated portfolios. For unrated portfolios, what you can do is you can observe the overdue on those loans. You can club those loans according to their overdue status. For example, first bucket is not due. The loan were not due in historical periods. Then you will see how those loans moved into next bucket in the next month. Yeah, so you can see the propensity here to, for example, we have 15,000 borrowers in not yet due bucket on January. This is the past history. So I'm computing the default rate, historical default rate. So out of these 15,000 customers, 355 moved into next bucket in February. So that is how I compute propensity of one bucket going into second bucket. By doing that, I can get the default rate by matrix multiplication. So this will give me a default rate for each bucket. Like not yet due, what is the default rate? How the loan will move into next bucket and then ultimately into default bucket. So it will give me not due buckets default rate, then 1 to 30 days bucket default rate, so and so forth. So these are called through the cycle PDs. Yeah. So through the cycle PD need to be made point in time in order to use for IFRS 9. So this is the recognized methodology to computing PDs, but you can always use other methods as well. Systems are available to compute PD. You can always use regression method to compute PDs. But if you don't have such models, you can always leverage your internal risk rating models. And based on that, you can compute PDs in this way. Okay. One thing to consider is that there are external ratings available in the market. So Moody's and S&P actually issue ratings for different borrowers, different categories of borrower according to their ratings. For example, AA has a rating, AAA has a rating, BBB has a rating. So those ratings cannot be used on loan book in a bank because those probability of default against those ratings is determined in a different jurisdiction where the default experience is different from Pakistan. So you cannot use those. So you'll have to develop your own loss rate based on your own experience of your portfolio in a bank. But for bank balances, for investments, you can use those PDs because in those cases, they are very limited default rate to compute PDs. So you can use those PDs, but you need to be very careful that even in investments, because we have a few instances of default in investments as well, like Agritech, Asgard, so they defaulted historically. So in using that PD, you need to be very careful what type of portfolio of debt instrument you have in your investments. So you need to be very careful about that while using those externally rated PDs. So we have computed the probability of default. That was the first part of loss rate. The second part is loss given default. So how to compute the loss given? So what is loss given default? Loss given default is basically the economic loss that you have incurred on your historical defaulted portfolio. एक लोन था वो डिफॉल्ट में चला गया and you only was able to get 20 rupees out of that. Say it was 100 rupees loan, you get only 20 rupees. So it means 80% is your loss given default. So you lost 80%, 80 rupees out of that loan. So that is your loss given default. Now how to compute that loss given default in a systematic way? So what you can do is you can identify NPLs over an observation period of say 5 to 7 years or 10 years and try to track the recoveries over those NPLs. Yeah. Once you have identified the recovery on the NPLs, then discount them back to the NPL date because recoveries are recovered over the period. So you need to discount those back to the NPL date. This will give you a recovery rate. Yeah. So recovery rate, if the recovery rate is 30%, it means your loss given default is 70%. So loss given default is 1 minus recovery rate. So that is how you can compute loss given default. So बहुत से लोग ये क्वेश्चन करते हैं कि why you are not taking collateral into account while computing the loss given default? Why you are observing the historical recoveries? Why you are not considering the collateral like mortgage? So the problem with the mortgage is that you cannot, legally enforce that mortgage in our legal environment. So you cannot demonstrate that substantial number of debt swap happened on your bank. So that is why you cannot use mortgage while computing the LGD, but you take into account the recoveries that have been made on that loan because of that collateral. Yeah, because you have a negotiation power with the borrower when you have a strong collateral. So those recoveries actually count for the collateral existence. But the collateral itself cannot be considered in the LGD. But yes, liquid collateral you can consider. Liquid collateral you can realize. You can consider those collateral. So once you have computed the probability of default, loss given default, next step is to compute exposure at default. So exposure at default, as I said earlier, it's not restricted to the outstanding principal. So you need to take into account the future drawdown as well. So if you have allowed a limit to your borrower, then you need to take that limit into account as well. But standard says that if you have a right to actually unconditionally and unilaterally cancel that limit, if you have a right to do that, then you can ignore the limit. Just restrict your exposure at default to outstanding principal. So this is one thing. Similarly, you need to take into account the unfunded facilities because you have a credit exposure there as well, like letter of credit, letter of guarantees, you have a credit exposure there. You need to take those into account. But for limits, that is not utilized yet, and for unfunded, entire amount is not required to be made part of exposure at default. you need to estimate the historical utilization of that limit, which is called credit conversion factor. You need to determine the credit conversion factor. That credit conversion factor will be applied to compute the amount of exposure at default out of those limits and out of those loan LGs and other unfunded facilities. There are two things to consider in exposure at default. One is the amount that we have already discussed about. The second thing is the life of the loan. What should be the life of the loan? So in case of closed-end loans, the life can be very easily determined. For example, you have a loan of 5 years. You know it will mature in 5 years. The life should be 5 years. But in case of revolving facilities, it's very difficult to actually estimate the life. So in that case, you need to take into account the behavioral life of the instrument. So behavioral life can be computed by observing the historical pattern of the repayment, historical pattern of the drawdown by that borrower, and for how many years that borrower will stay with you. So you need to understand through historical data. So if for example, in case of revolving facility, like overdraft, the borrower remains with you for say 3 years, so you cannot only take 1 year life. So you will have to extend the life to 3 years because that is based on the behavioral pattern of that loan. But again, standard says that if you can unconditionally and unilaterally cancel that anytime, you can call that facility, then you can restrict the life to contractual arrangement. Yeah. So these are the two aspects that need to be considered in exposure at default. So by now, we have computed the probability of default, loss given default, and exposure at default. Staging was already done, segmentation was done. We have computed the risk parameter for the expected credit loss. Now we need to build scenarios, how we can actually meet the requirement of Ifrs 9 by building scenarios. So the Ifrs says that whatever source you are using for macroeconomic factors, because scenarios are based on macroeconomic factor, because it's a forward-looking provision, so that is why macroeconomic factors are taken into account. So for example, GDP, unemployment, any other macroeconomic factor. So the source should be very reliable. So Ifrs says that it should be taken from a reliable source. So generally what we do is we obtain those factors from IMF, because 5-year prediction is available at IMF website for Pakistan, for GDP, for unemployment, so you can always source the data from there. Then the time horizon should be considered. Their minimum 5-year forecast is required. So it again depends on the reliability of the forecast, whether it is available or not, but generally 5-year forecast is a reliable forecast and it can be used for Ifrs 9 modeling. Then you need to consider the relevance of those macroeconomic factors with your portfolio default rate. So you cannot just select the macroeconomic variables. You need to demonstrate that there is a relationship between the default rate and the macroeconomic factor. So you can always use regression to establish that linkage between default rate and the macroeconomic factors. For example, I'm using GDP. So I need to first test whether that GDP has any correlation with my default rate or not. First, I need to establish that. If I cannot establish that, I cannot use that factor. So this is done by statistical regression method. Then the last thing is to develop the scenarios. As I said earlier, that single scenario would not suffice the requirement of Ifrs 9. You need to develop multiple scenarios. 2 are sufficient, but more than 2, you can do that based on your chosen methodology. That can be done. So that is how actually we compute expected credit loss. So what we are doing, first we are doing the segmentation of the portfolio in order to group the assets according to their risk characterization. Then we are doing staging of the portfolio in order to understand what would be the level of provision in those stages. Yeah, so 12-month or lifetime. So what is 12-month lifetime? Let me explain further that. So you have a loan of 5 years, and it's a monthly repayable loan. So it means that you have a 60 installment. So if the loan is in stage 2, it will attract lifetime expected credit loss. So you will have to apply probability of default, loss given default on each of the 60 installments, right? But if the loan is in stage 2, it will attract 12-month expected credit loss. So in that case, you will compute the expected credit loss for the entire life of the loan, but you will select or you will appropriate certain amount that is to be allocated to 12 months, to the next 12 months after the reporting date. You do not have to book entire lifetime loss for stage 1 loan. So this is the concept of stage 1 and stage 2. So we have done the segmentation, we have done the staging of the portfolio. Next step is to estimate the expected credit loss. In estimating the expected credit loss, you need probability of default, you need loss given default, you need exposure at default. Once you have determined that, you develop scenarios, and by giving the probability weights to those scenarios, you will get expected credit loss number. So these are some of the challenges that I've just jotted down here that we faced on different banks while implementing IFRS 9. So first challenge is the computation engine, because there are a lot of data involved in IFRS 9 implementation, so you need a computation engine for that. It cannot be done on Excel. There has to be a system with certain language. Yeah? Then integration of the data into the ECL engine, because even if you have a ECL engine, you need to integrate your data source with the ECL engine. Otherwise, it will not be a reliable number, because the data may become corrupted when it is transferred to the ECL engine. So that need to be integrated. So there you will find a lot of issues. Then determination of models for 12-month and lifetime expected credit loss and their statistical relevance. So this is very important, because sometimes what happens is that a consultant develop a model for you, like consultant has developed a PD model for you. Next year, you are just putting the data into it without actually looking at the reasonableness of results, whether that model is now working properly, because the model is adjusted according to the data. So normally risk department person in a bank, they know what sort of data they have and what is the reasonableness, what is the statistical reasonableness of that model according to that data. So that need to be considered. You cannot ignore that. Then you have defined responsibilities. Generally, it is presumed that it is the responsibility of finance department. So this is extremely wrong. Under IFRS 9, finance department alone cannot compute expected credit loss, because these risk parameters like PD, LGD, these need to be vetted by risk management department. It is not sole responsibility of finance department to compute ECL. So responsibilities need to be carefully defined. Even IT department, CAD department, because they are providing the data for IFRS 9, so they need to be involved in this exercise. So it's a combination of different departments. So responsibilities should be clearly defined in order to implement this ECL. Then source and reliability of data, obviously you need to see how the data can be extracted. Sometimes you have a manual records, it's very difficult to actually put that data into the system. So these are the challenges that different financial institutions are facing while implementing IFRS 9. So I think more or less, I think I've covered my presentation. So Salman, let's start with question answer.
Thank you, Rehan, for a wonderful presentation. We have now like 20 minutes allotted for the Q&A, and I request if Arslan and Rehan can please come here for a while. So if there are any questions, just raise your hand and the mic will be there with you. So we'll start with any question. We have 15-20 minutes allocated for this. So please feel free to ask any questions.
Assalamu alaikum. I'm Habib. My question is related to gross carrying amount. As you have mentioned in your slide, depicting different stages, stage 1, 2, and 3. In the bottom of that slide, you mentioned that gross carrying amount for stage 1 would be different, stage 2 would be different, and for stage 3, that would be net carrying amount. If I'm understanding correctly, it is also linked to when I'm calculating EAD, means do I need to calculate profit till maturity as well? Because I can understand that IFRS 9 is linked to the future cash flows, but the profit which I have not earned or which is not even due today or not would be due in the upcoming year, should I also account that in my EAD and then calculate the whole ECL on that EAD?
Yes, actually, look, if you ignore the probability of default and loss given default, right? So you have a principal of 100 and there is a markup rate of 10% and the loan is of 10 years or 5 years, let's suppose. So you will have 50 rupees accrued markup over the years, yeah? And I discount that at the same rate of markup. So you will end up with 100 rupees again, yeah? Ignoring the probability of default and loss given default. So it means that you need to accrue the future markup because discounting will not have anything to do with the impairment. Impairment is based on probability of default and loss given default. So this markup is accrued because you are discounting that again. So that is why it is important to accrue markup. Yeah?
Very well answered. Just another add-on.
Yeah.
I would not do that for stage 1, right? Means till maturity. If it is a 5-year loan.
No, not necessarily. You will have to accrue the markup for stage 1 as well.
No, I will accrue markup for just 1 year for stage 1 because
Yes.
I'm calculating.
Yes,
lifetime.
obviously.
Thank you.
My name is Ifrs. I just wanted to ask if a exposure has been declassified from stage 1 to stage 2 just because of downgrading of ORR in that specific period, is there a methodology to reclassify it to stage 1 if it has maintained its ORR rate?
Yes, there is a concept of backward staging. So we have discussed the forward staging, right? So if the loan has, revert back to its original obligor risk rating, so you can revert it back to stage 1. That's allowed.
It has not reverted back and has maintained that ORR for considerable time.
It's just not the ORR. I think normally you need to fix a policy because a loan where the credit risk has substantially increased after the origination, that's the reason why you transferred it to stage 2 loan. Now because the circumstances around that loan has improved, so you need to test it. For example, normally an observation period of 1 year or 6 months is normally considered as a policy that if that condition of a loan has improved and it continue to reflect the improved condition for 6 months, then obviously, you have a basis to transition into the stage 1 loan. What you're trying to say is that the significant increase in credit risk, the factors that contributed to increase in the credit risk have actually changed. So for example, previously the loan was showing overdues by 30 days or 60 days, and that's the reason why, or the ORR rating, because of their business conditions or other factors, were assessed that the credit risk has increased on that loan. So if the business conditions have improved, the operating conditions have improved, and the loan is, and there are no overdues, the recoveries are on track. So you give us 6 months to 1 year of an observation period depending on the policy you choose, and then transfer it backward to 1 year. So you have to build a policy mechanism within your IFRS 9 policy for backward transition. It's just not that you one day fine morning you'll just change the rating and will be able to move it backward. So you have to set some rules so that it's not misused.
Currently, there is a cooling off period of 6 months in state bank guidelines for backward transition.
Yeah, 6 months. I think initially they wanted 1 year. And then obviously the banks said because 1 year is quite long. So 6 months is normally acceptable as well, I think, internationally.
Over here, second row.
If I can ask another question, please. What's your view on the article of the State Bank which says that now the government can also default? So the whole government-backed securities and public sector entities, the benefits which banks were taking against those, considering it to be a safe loan, would that be changed? Because it would be a very drastic impact on IFRS 9 impact assessments on all financial statements.
Look, I think I think we have not covered this in the presentation, but I think I'm happy that you have asked this question. The government securities, normally, as a principle, yes, government securities, like any debt security, is subject to an ECL provision, expected credit loss. Now, the question is, if you apply these principles of expected credit loss, what is the probability of default on a government or a sovereign exposure? Then you have to look at how, unless you have your own models to predict the probability of default like a corporate loan, you also look at the credit ratings that the world has given you in terms of S&P rating or other credit agencies. Given the Pakistan health, the problem is that the credit rating that those rating agencies have assigned to Pakistan is not very good. It's BBB plus or something like that. It's not default rating, it's not high risk, but it's one notch above that. And they also publish, international rating agencies, that what is the probability of default on a sovereign exposure which is rated as BBB. So the probability of default based on an international experience on a BBB sovereign exposure is around 8% or so, right? And if you apply 45% LGD on that 8%, so 8% into 45% comes to about 3%. So the loss rate, net loss rate is 3%. Given the rating of Pakistan. Now, people also argue this rating is based on a foreign currency exposure other than the local currency exposure. The government securities are issued in a local currency rather than a foreign currency. So international rating agencies are more looking at the country's ability to pay foreign currency rather than the local currency. And there is one school of thought and argument that the country will be able to print currencies to prepay the debt. But it's not entirely true, because there are, economically it's not feasible to print unlimited amount of currency. So this certainly is a debt of the government, and the government is rated BBB. And if you look at the international view on the BBB, that gives you about 3% or 3.5% of the net loss from that experience. So unless you ignore this model and you go to your own model, that okay, this is the international view on my credit risk on my sovereign, I also look at my internal history. I develop my own model on the government exposure, which means I look at Pakistan's 70-year history, how many times Pakistan have defaulted on the government exposure, and there is various kind of government exposure, government securities, the loans which were guaranteed by the government, the IPP loans that actually went into restructuring. Some, I think in the history you have also availed in the Paris Club, the rescheduling of loans. So there are, if you try to plot point of default or rescheduling is also, by the way, is a form of default. So there could be point of default, but they may be few. So either you develop your own assessment of government's ability to default, or you accept the international view and rating view. So it can be anything in between that 3.5% or your own model, whatever that gives you. So that ECL provision, technically speaking, should be considered for the government exposure. But the problem is that obviously this 3% is an unbearable value. Obviously, if you apply the government exposure exposure across the banking sector apply 3%, I think it will erode the capital of many of the banks, you know. So in many jurisdictions, you will find where there are weak economies, there are relaxations allowed on ECL provisions on the government exposures. There are examples in jurisdiction. So again, Pakistan has an option either to consider an exemption on the government exposure, because exemption means looking at the Pakistan history of default. We have never defaulted on PIB and T-bills on government liability. So that can be a basis to consider that regardless of going into the rating and ECL risk, if the central bank feels that there is no risk or virtually negligible risk on government securities, they can facilitate the ECL provisions on government securities. But they have to justify it with a rationale, because otherwise I think international agencies may raise concerns that, you know, this is an exemption regime rather than an Ifrs 9 compliance regime. On the other hand, if you imagine a scenario that, for example, you say there is a ECL of 3% on government securities. So the market which is buying government securities at a risk-free rate, discount rate, say 10% today, will ask for 13% rather than 10%. So the basic risk-free rate is not risk-free, it will increase because the banks will not pay this 3% out of their own pocket. They will recharge to the market. So the lending rates or the government security rate will increase from 10 to 13%. And obviously that will trickle down to the corporate lending rates as well. That will also increase. So this has an economic impact as well. At the moment, if you look at the government security rate, it is equal to the discount rate. And discount rate is again tied with the inflation rate. So the government and the market, not the government, the financial market is saying that we consider almost zero risk on government exposure because whatever is the inflation is the ask of the market on the government exposure. So they are not asking for the credit risk. They are not asking a credit risk premium because market believes who is the market? The banks essentially. Because the banks feel that this exposure is risk-free, where the international view is that this is not a risk-free exposure because of the economic health, because you are looking towards the balance sheet of the government. And you are saying that because of your current account issues, your other, the balance sheet of the government is not of such a level or is not showing that rosy picture that they will be able to meet all their liabilities without any concern. So there is a genuine concern that the government exposures are not risk-free given the economic position of the government at this point in time, and that is reflected in the credit rating. Now, economic position can be argued whether it's good, bad, worse, but it, the rating agency view cannot be ignored in that. So I think the solution lies in between that, whether all kinds of, the problem is we are equating everything like PIBs, T-bills and government loans and government guaranteed exposure. They are like the same. So the loan that you have given to say food department or civil aviation or Pakistan Steel, you can't equate it with a loan that a PIB or T-bill. So they have varying degree of credit risk associated. So first of all, I think we have to look at debundle government exposure into pure government securities and then government guaranteed exposure and other exposures. And then say, okay, certain government securities historically have not defaulted. They carry lesser risk as compared to the government exposures, which are public sector exposures, which are government direct borrowing exposures, etc. They may carry a higher risk and subject to a risk of. And by the way, I think even if you assume that those exposures are 100% realizable because of the delay that you get in even receiving your 100%. So the IPP's exposure towards the government may carry interest, but I think nobody is realizing late payment charges. So they eventually have a time value of money loss, which should be accounted for. So it's a complicated issue, but at the end of the day, I think the if you just look at purely from IFRS 9 angle, to say that government is risk-free is not the right approach.
Thank you. My name is Vasit. जो not yet due जो exposure है उसपे ECL calculate करने की क्या रचना है? जो not yet due
नहीं, देखिए हम एक्सपेक्टेड लॉस पर जा रहे हैं, ठीक है. एक्सपेक्टेड लॉस का मतलब ये है, व्हाट इज द क्रेडिट लॉस? डिफरेंस बिटवीन योर कॉन्ट्रैक्चुअल कैश फ्लो, ऑल कॉन्ट्रैक्चुअल कैश फ्लोज that as a result of the contract you will get in the future, and your expected cash flows is a credit loss. तो आपने एक लोन को देखना है over its lifetime. You are not looking at today's loss. अगर मैं ड्यू को देख रहा हूँ तो आज के लॉस को देख रहा हूँ ना, कि ड्यू में से कितना रहे. अब मैं कह रहा हूँ कि over the time of the loan, because I have originated the loan today, I have taken this exposure today, or I have not given one loan, I have taken a portfolio of loan. तो अगर मैं ये कहूँ कि मैं सारे लोन्स पे मुझे फ्यूचर में कोई लॉस नहीं होगा, तो इट्स नॉट अ लाइकली सिनेरियो. It is inherent in the business model that you will incur certain loss on certain, although they are not due, but certain loans will turn bad, certain loans will remain good. Expected credit loss model is what is the expectation of future credit loss. What is expected in the future, you start providing for today, right? तो expected future loss 3 years down the line, उसकी present value मुझे आज provide करनी है. I'm not saying 100% of my loan will go into default. That is why probability of default comes into play. अब probability of default का मतलब ये नहीं है कि किसी लोन के ऊपर मैंने ये probability of default कहा है कि 3% probability of default है, तो 3% default में नहीं जाएगा. It's an average which has been applied over the whole portfolio. तो उसमें से एक on that segment of portfolio, तो कोई एक लोन ही जाएगा, कोई दो लोन ही जाएगा, but that will be a 3% of the total portfolio. So probability of default का मतलब ये है कि future में क्या होने जा रहा है उसको आपने predict करना है through some mechanism कि future के जो losses, credit losses ये बैंक incur करेगा anyways because they are in that business, उसके ऊपर जो losses हैं वो हम आज से उसके ऊपर provision built up करना शुरू करें. So जब actually वो loss realize होगा, हम stage 1, stage 2 पे provision build कर रहे हैं. Stage 1 और stage 2 में से कुछ लोन stage 3 में जाएंगे तो you will have certain provision already on the books. तो stage 3 में जब वो jump करेगा तो 100% provision नहीं करना पड़ेगा. Already आपके पास stage 1 और stage 2 का provision books में मौजूद है. तो आपके पास एक shock absorber मौजूद है in the books. तो in times of economic crisis जैसे 2008 में है, आपको एकदम losses नहीं लेने. You have already provisions built up for that period, तो आपको shocks नहीं आएंगे in the economy. तो आपको एक अर्निंग स्मूथनिंग होगी कि ओवर टाइम स्टेबिलिटी रहेगी कि आपने ऑलरेडी प्रोविजंस बुक किए हुए. अब ये फॉर एग्जाम्पल अब ECL प्रोविजंस आर डिपेंडेंट ऑन द फ्यूचर मैक्रो इकोनॉमिक सिनेरियोज एज वेल. आज आपकी GDP ग्रोथ 4% है और फोरकास्ट ये है कि 2% हो जाएगी, तो जब मैं प्रोबेबिलिटी ऑफ डिफॉल्ट निकालूंगा, आज की मेरा हिस्टोरिकल रेट ऑफ डिफॉल्ट फॉर एग्जांपल 10% है और मैं कह रहा हूँ कि GDP मेरा कंट्री का स्लैश होने वाला है, तो मैं उस 10% को फॉरवर्ड लुकिंग करने के लिए 12% कर दूंगा बिकॉज देयर इज अ कोरिलेशन बिटवीन इकोनॉमिक indicators and my default rate. Obviously, when economy will go down, there will be more defaults. So जब economic condition आपकी ख़राब होगी तो आपका ECL provision भी ऊपर जाएगा. अभी loss नहीं हुआ है, लेकिन आपका ECL provision ऊपर जाना शुरू हो जाएगा. और जब आपकी economic condition improve होगी तो आपका ECL provisions down होना शुरू हो जाएंगे. Although कि अभी we have not jumped to a default situation. तो it's a proactive approach to make provisions rather than waiting for the time कि आज 2008 में क्राइसिस हो गया, 2010 में लॉस बुक कर रहे हैं, क्योंकि उस 2008 में क्राइसिस हुआ, उसकी बिजनेस कंडीशन खराब हुई, 1 साल तक उसने इधर उधर मैनेज किया, उसके बाद डिफॉल्ट किया, फिर आपने प्रोविजन करना शुरू किया. सो प्रिडिक्टेबिलिटी एंगल इसमें, एक्सपेक्टेशन इज प्रिडिक्टेबिलिटी एंड एक्सपेक्टेशन, बट देयर इज ऑलवेज एन एलिमेंट ऑफ अनएक्सपेक्टेड लॉस जो अभी इसमें नहीं आया. We are still talking about what can be expected. So there could be something which is unexpected. लेकिन unexpected की बात अभी standard नहीं कर रहा, लेकिन expected की ज़रूर कर रहा है.
Last question, second row.
Hello. I just want to seek the clarification about exposure at default. in one of the slides, it was written that exposure at default is the current outstanding balance plus credit conversion factor into undrawn amount. Just want to know that in case of one scenario where the outstanding balance of that consumer is 1 billion and it has another, the total limit was 1.5 million. So in that scenario, will I be considering 1 million as exposure at default or 1.5 million, which I know that in the future the consumer might obtain more limit which has been assigned. And what will be the basis, because the bank has not earned any interest on the undrawn amount.
Yeah, actually look, the 1 million is basically on balance sheet. That should be considered as exposure at default. 500 is off balance sheet. So for example, your trade conversion factor is 20%. So 20% of 500 would be considered as exposure at default from that undrawn portion, right? So the idea here is that you are, because you are computing the future expected credit loss, you need to consider those exposure where you are committed, although not drawn, but you are committed to that. So there is a credit risk. So IFRS says that you will have to compute the credit risk till the period you are exposed to credit risk, yeah? So in that case, you are exposed to credit risk till the time you have given that limit. So that is the reason for that.
What is the, my name is Babur. What is the guidance given in IFRS 9 for at what discount rate we have to discount the cash flows? For example, there's a case where receivable is staggered for maybe 4 or 5 years, and then we have to discount it. But initially, the discount rate was 0, for example. And at what rate we will discount the cash flows for ECL calculation?
Yeah, so if the receivable is interest bearing, so that would be effective interest rate of that receivable, yeah? If you don't have a receivable, interest on that receivable, then you can consider the borrowing rate of the company, because that is incurring the opportunity cost.
At that balance sheet date or the historic or the average of the reporting period?
I think as at the balance sheet
The
date.
balance sheet date, implicit rate of return,
Yeah.
interest. You have to impute the rate of interest.
Incremental rate of borrowing?
If not explicit.
You're saying the incremental rate of borrowing? Or risk-free rate?
Normally, the trade receivables do not carry interest rate, right?
Yeah.
So trade receivables means, but why they are actually, there is no time value of money concept and we apply a simplistic approach because of the short duration, 1 year. But they have an implicit rate of interest because of the borrowing and the working capital. But we don't go into that discussion because of the short duration. So for ECL, for trade receivable, you don't consider time value of money.
In case the receivable, like for example, we give installments.
If there are long-term receivable, if the 5 year
Long-term government receivable you're talking about.
a long-term government receivable has a financing component because it's a, so then you take into account the current borrowing rate that you actually have. You have to impute an interest rate, that this is the interest rate that inherently is carried in this receivable. Islamic Bank, no, Islamic Bank are considered for IFRS 9 purposes like a conventional bank, right? So they look at the substance rather than the underlying contracts. So it is treated like a financing. It is treated like, although it's not a, they will not say that it's a time value of money and the credit risk premium that they are charging. They're not charging interest, but effectively they're charging time value of money and credit risk. So on the IFRS definition of interest, it is an interest. But on the Islamic and Sharia definition of interest, and please don't get me wrong on it, like we have to apply an IFRS definition whether or not it's a, because Sharia concept is that there is a profit element on the transaction. Now whether that profit element is equal to the same lending element of return, I think then you need to look at the substance. The substance is what you are charging. You are charging time value of money and the credit risk premium. Now, is there any other way of determining the profit? based, for example, if you're dealing in commodity, are you tying up your profit margins with the commodity margins, or you're tying up with your profit margin on any other way of business margin? The answer is no. The margins that the Islamic banks are computing is CIBOR plus 2%, CIBOR plus 1%. That is time value of money plus the credit risk, and the 2% is the credit risk premium that they are charging. So for EOF body, which is the Islamic Accounting Standards body, they are also, because they issue Islamic Accounting Standard, and they also are adopting IFRS 9. They have not yet adopted, I think exposure draft have been issued. Principally, they agree that IFRS 9 can be adopted for the Islamic institutions as well. So, and the global Islamic institutions that you have in UK, Malaysia are already on IFRS 9. So I don't see much a difference in, there could be certain products which may be treated differently, but if you purely go and say, okay, we are not charging interest, or we are charging profits, and this is based on our own assessment of risk associated with the transaction and the investment that we are making in the product or commodity or the business, then you are telling, in terms of IFRS 9, that all of that has to be fair valued. Because anything which is not a basic lending arrangement, under IFRS 9 methodology, it has to be fair value. So you have to fair value all those instruments which are carried by Islamic banks, which is not happening actually.
Okay, due to time constraint, we cannot take further questions, but thank you very much, Arsalan, Rehan, for a wonderful presentation and answering some very good questions, and I think they deserve a big round of applause. Now I request Farooq Rahman Saab, Council Member and the Session Chairman, to please have some word with us here. Thank you.
Bismillahirrahmanirrahim. Assalamu alaikum. Arsalan and Rehan, brilliant. I think ये जो टॉपिक है ये कॉम्प्लेक्स टॉपिक है, और IAS 39 के बाद IFRS 9 दोनों को समझना और दोनों को डिफरेंसेस के साथ एक्सप्लेन करना, दैट रिक्वायर्स सम अंडरस्टैंडिंग. सो ब्रिलियंट. From the perspective of the institute, let me tell you that we at the institute has always adopted and worked with IFRS. So when this IFRS together with some other, उसमें भी एक big 3 IFRS की बात होती है, तो 15 भी और 9 भी और 7 भी आया था, और अब 16 की भी बात है. So we at the institute and accounting standard board के अंदर, where we actually deal with all the accounting matters, whether that is the adoption, delay, or issuing any kind of explanation or guidance that happens within the forum of the accounting standard board. So we recommended to SSCP, who actually issues the notification for adoption of IFRS 9 or the other IFRSs. So this was done, but in the process we had extensive stakeholder discussion as well. But in all those discussions, one factor consistently came. Arsalan भी जानते हैं, पहले भी हमने कई public जब इस पे discussions भी की, वो इसमें guidance और consistency across all, अगर banks हैं तो banks के लिए है, similarly जो sector है वो NBFIs का भी है, मुदारबाज भी हैं. So उन सब के लिए जो है, जो sector है, that requires consistency, or so that everybody is reading from the same page. So in that respect, again, State Bank has issued the guidance. So अगर आपने इसके further details देखने हो और actual implementation में, तो there is guidance available or issued by State Bank. Of course, we had from the Accounting Standard Board input into that. But also for NBFIs and Mudarbaz, the IFRS 9 guidance has been in place, और वो भी issue हो गई है. Just last week, NBFIs के लिए जो है वो NBFCs के लिए एक सेशन भी किया था, जिसके अंदर हमारे यहाँ से लोग मौजूद थे. So the role that we play is to really give supporting learning material guidances so that we all get up to the mark. I think दो यहाँ सवाल बड़े सेंसिटिव मैं कहूँगा नेचर के थे. एक जो बात हुई विद रिस्पेक्ट टू जो गवर्नमेंट की या सॉवरन रिस्क की उसकी इनकॉर्पोरेशन की. आई थिंक इसका जो रियल इशू था वो द वे दिस वाज प्रेजेंटेड और रिपोर्टेड इन द मीडिया, उसमें एक ड्राफ्ट जो कि इनिशली इशू या स्टेट बैंक ने जो गाइडेंस के डेवलप करते हुए किया था, और उसके बाद जो एक फाइनल उनकी गाइडेंस इशू हुई जिसके अंदर पहले इसको कहा गया था कि जी ये कोई सॉवरन रिस्क को आप नहीं इनकॉर्पोरेट करेंगे, एंड देन वो चीज़ जो है या वो सेंटेंस जो है वो इसमें से निकाल दिया गया. सो द वे दिस वाज पोर्ट्रेड और प्रेजेंटेड वाज कि गवर्नमेंट ऑफ पाकिस्तान का जो डेट है या वहाँ जो है वो डिफ़ॉल्ट हो सकता है. तो ये जो सेंटिमेंट था, मुझे जिस तरह के फ़ोन आए और जिस तरह की इसके ऊपर डिस्कशंस होनी शुरू हो गई थी, तो उससे मुझे तो ऐसा लग रहा था कि हुकूमत हिल रही है एक IFRS की इंटरप्रिटेशन से. सो दैट इज़ अ वेरी सेंसिटिव सब्जेक्ट, एंड मेरा अभी भी ख्याल ये है कि इन क्लोज्ड कॉरिडोर्स ये एलिमेंट जो है वो स्टिल डिबेटेड है, क्योंकि द वेरी कॉन्सेप्ट, नो मैटर व्हाट IFRS 9 सेज, एंड वी ऑल प्रोफेशनल्स विल ऑलवेज स्टैंड अप विद कि जी IFRS अगर ये कहता है तो वही है. लेकिन when you come to the practical part of it, when you are running a government, to give this sentiment that there is a risk of default has some consequences. Some of the consequences, Arsalan explained that जो interest rate है वो उसमें convert हो जाता है, but it's a very sensitive topic, and close corridor में I think still ये बात हो रही होगी. जो सेकंड बात हो रही थी वो रेज हुआ है विद रिस्पेक्ट टू इस्लामिक. आई थिंक दैट इज़ अगेन अ वेरी सेंसिटिव सब्जेक्ट. जब भी हम इस पे बात करते हैं अकाउंटिंग की, शरिया बेस्ड ट्रांजैक्शंस की, तो मैं लाइटर मोड में कह रहा हूँ इस्लाम ख़तरे में आ जाता है. तो एक्चुअली इस चीज़ को जो है वो बड़ा प्रैग्मेटिकली अगेन वी नीड टू डील विद इट. मैं हर फोरम के ऊपर और इवन अभी हम इसको देख भी रहे हैं अकाउंटिंग स्टैंडर्ड बोर्ड में, जो इम्पॉर्टेंट चीज़ फॉर ऑल ऑफ अस टू अंडरस्टैंड इज कि देयर आर ट्रांजैक्शंस एट द मार्केट प्लेस, और वो ट्रांजैक्शंस ओवर द ईयर्स हैव ग्रोन अप. सो दोज ट्रांजैक्शंस आर हेयर टू स्टे. सो दिस इज़ अ रियलिटी. So once the transactions are being carried out in the market, there has to be a response. अगर ट्रांजेक्शन होगी तो उसकी अकाउंटिंग होगी. So वो जो अकाउंटिंग होगी उसके अंदर राइट नाउ असलान ने भी एक्सप्लेन किया कि जी you have to apply the IFRS. So as we speak, the framework here in Pakistan is IFRS. So those transactions have to report in accordance with IFRS, though there are views. So what we are doing at in the Institute or the Accounting Standard Board, we have researched every type of the financial instrument, जो भी एक टाइप ऑफ फाइनेंसिंग कह लें या शरिया बेस्ड ट्रांजैक्शन जिनके अंडर हो रही होती है, उसमें इजारा भी शामिल है, उसमें आपके मुशारका भी होगा. सो ये तमाम ट्रांजैक्शंस जो है उसको एक मॉडल एग्रीमेंट जो कि स्टेट बैंक ने इशू किया हुआ है, उन एग्रीमेंट्स को थ्रू द स्कैन ऑफ IFRS हमने गुजारा है, एंड देन वी हैव कम अप विद कि जी इस अगर हम मॉडल एग्रीमेंट को या शरिया बेस्ड ट्रांजैक्शन को अगर हम IFRS के स्कैन से गुजारेंगे तो इसका क्या नतीजा निकलेगा. सो दैट इज़ व्हाट इज़ बीइंग डन, एंड दैट इज़ बीइंग अगेन स्टेट बैंक SSCP, क्योंकि वो एक स्टेज पे हमने उसको बना लिया हुआ है, और वो पब्लिक में भी फॉर कमेंट्स वगैरह एट अ लेटर स्टेज इशू होगा. बट दैट इज़ वन सब्जेक्ट जिसके ऊपर व्यूज़ हैं, बिकॉज व्हेन वी इंटरेक्ट विद AOFs, तो AOF में जो है वो अगेन उसका पर्सपेक्टिव डिफरेंट है. प्राइमरी डिफरेंस जो है वो सब्सटेंस ओवर फॉर्म का है और टाइम वैल्यू ऑफ मनी का है. बट व्हेन वी गो एंड सी दिस इन द कॉन्टेक्स्ट ऑफ व्हाट मलेशिया हैज़ डन, आई थिंक देयर आर सम एक्सीलेंट literature that they have published, and it is worth reading. Those who are interested, I think they can look at those publications, अच्छी मोटी publication है, उसमें तमाम aspects, including this aspect of justifying why IFRS. But again, as I said, there is another view. But here in Pakistan, at the moment, the framework is IFRS, so all those transactions are being scanned through the eyes of or lenses of the IFRS. एक और important aspect I think I should highlight is जिक्र हो रहा था कि अब तमाम जो है वो fair valuation में आप instrument को कैसे जाएंगे, even जो unlisted entities है उनको भी mandatorily अब आपने fair value equity instrument है तो आपने उसको fair value करना है. Fair value कैसे करना है, again IFRS 9 में नहीं है, we go to the IFRS 13. So the question is कि IFRS 13 तो मौजूद है, but when you actually implement it, when you actually apply this, I have seen, you know, बहुत different valuations निकल कर आती हैं. Best of the best दो लोग भी जो हैं वो they end up with difference. और मैंने बहुत सारी valuations ऐसे भी देखी हैं जिनके ऊपर बहुत सारे questions भी हो सकते हैं. So what we are doing is that we are exploring and we are seeing कि जो international valuation standards हैं, how those can be relevant in our market, so that all of us, all professionals in making the fair valuation and recording in the financial statements. Because what is our end objective? The end objective is that the financial statements need to be credible, they need to be useful. So in that respect, अगर हमने उसकी credibility enhance करनी है, तो we all have to read from the same. So that is again being an important aspect, because जो valuation है वो सिर्फ IFRS 9 के जो subject matters हैं उनको नहीं करता, but if you go to IS 16 तो वहाँ अगर आप property plant and equipment की revaluation कर रहे हैं तो वहाँ भी बहुत सारे लोग यहाँ बैठे हैं, they can understand what I'm saying कि वहाँ भी जो fair valuation आती है उसमें कितने matters होते हैं for discussion. Intangible की valuation में जाएं तो वहाँ issues होते हैं, business की valuation में जाएं, so derivatives है. So it's a very complicated and a big subject. Or once we conclude on that, again that will be food for public discussion as well, so that our financial statements, financial reporting in Pakistan gets the credibility it deserves. So with that, I think I will not take much of your time. I think it's an excellent seminar, and Salman, continue with that. Thank you.
Thank you, Farooq Saab, for your wise words. Now I would like to request Southern Regional Committee Chairman Usama Rashid Saab to be here and have some words and present the mementos to our presenters and session chairman Saab. Thank you.
Assalamu alaikum. Thank you very much, and thank you to the CPD team for organizing this seminar at the very right time. इस वक्त जो ये start होने लगा है, this financial year for the banks, जिसमें ये IFRS applicable हो गया, so I think it's really very right time to have this seminar. And also I'm also very pleased because this is the first event of this year जिसमें हम ये seminar कर रहे हैं इस तरह का, and also first seminar from this brand new SRC. So thank you very much all of you for attending this seminar, and also thank you to our speakers for very effectively delivering this IFRS, and also for very intriguing questions from your side and very aptly summarized by Farooq Saab. So thank you very much all of you once again, and I would like to also take this opportunity to request all of you to share your suggestions and feedback, if any, on an email address. If you can display that email address over here. और कोई आप समझते हैं कि कोई future professional developments के हवाले से क्या programs conduct करने चाहिए इस program के हवाले से, if you have any feedback, please feel free to share your feedback on this email address, and we will be looking forward to take that into consideration. So thank you very much once again.
I request Arsalan to please receive his memento from SRC Chairman Usama Rashid. I request Junaid Ali, a member SRC, to please here as well. Now I request Mohammad Rehan to please come forward and receive the memento. Farooq Saab, please. Thank you very much, Osama, Junaid, and Farooq Saab. Okay, in the end, I would like to thank all of you to be here with us and looking forward to welcome you in more upcoming sessions of SRC. We have another plan for 17th of March on another important topic, which is going concern, which is very practical issues and implications we are going to discuss in that. So I hope to see you all again and grace this occasion like this. And the dinner arrangements are just outside this hall. And again, I would like to thank you, every one of you. Please enjoy the dinner and have a great evening. Thank you.